Supply refers to the amount of a product or service that a producer is willing and able to provide to the market. An example of supply would be a local bakery. The local bakery owner may decide to bake 100 loaves of bread, let me say on Monday. This represents the bakery supply of bread for that day. As customers purchase the bread throughout the day, the supply decreases. If the bakery sells out the bread before the end of the day, the supply is exhausted. If the bakery has any bread left over at the end of the day, they had a surplus. The bakery owner may adjust the supply of bread they bake on subsequent days on basis of the previous sales and demand they anticipate. For example, if they usually sell out breads on Monday, they may decide to bake more bread the following Monday to meet up the expected demand. Demands refer to the amount of a product or services that customers are willing and able to purchase. An example of demand would be the number of customers who want to purchase the bakery bread. On Monday, the bakery may have 100 loaves of bread available for sales, but if 200 customers want to buy the bread, the demand exceeds the supply. If this happens, the bakery can either increase the price of bread or bake more bread to meet the demands. Also, if only 50 customers want to buy the bread, the demand is less than the supply, and the bakery may have to lower the price of bread or bake less bread in the future to avoid surplus. In summary, demand is the amount of goods or services that the customer are willing and able to purchase at a given time and price. Market equilibrium is the point at which the quantity of a product or supply equals the amount of demand and there is no surplus or shortage. An example of market equilibrium will be like a local farmer. For example, if the farmer brings too much produce to sell, the price will drop and some of the produce will go unsold. If the farmers don't bring enough produce, the price will go up and some customers will be unable to purchase the produce they desire. At the market equilibrium here, the quantity of the produce brought by the farmer will match the quantity that the customers want to buy and the price will be stable. Macroeconomics is the branch of economics that deals with the behavior of individuals, households, firms, and how they interact with the market. Macroeconomics examines how individuals and firms make decisions, how they allocate resources, and how they interact with one another in the market to determine price and quantity of goods and services. An example of this macroeconomics is when the firm decide to expand or decrease their production. For example, a small clothing manufacturer may decide to increase the production if the raw materials decreases or demand for the clothing increases. On the other hand, the same firm may decide to increase the production or the cost of raw materials increases or if the demand for their clothing decreases. Circulation flow of income unexpected is a model used in macroeconomics to describe the movement of money and goods throughout an economy. For example, households sell labor and other resources to firms in exchange for wages and other payments. Gross GDP. Gross GDP is the total value of all goods and services produced within a country during a specific period, usually a year. It is widely used to measure the country economic performance and is considered a key indicator in the standard of living of a country resident. GDP is commonly used to compare the economic performance of different countries. To calculate GDP, economists use one of the two methods, the expenditure approach or the income approach. The expenditure approach adds up spending by household, business, and government on goods and services. The income approach adds up all the income earned by residents of a country, including wages, rent, and profit. Example, a country GDP is $100 billion. Its total consumption is about 700 billion. Its total investment is about 1 trillion is this, then the total consumption is 700. The total investment is 200. Government spend about 150 billion and the net about 50 billion. This can be calculated using expenditure approach by adding up all the total sums, total investment, government spending, and the net export, and it will give us our GDP, meaning national income is important because it gives a snapshot of economic performance of a country. It allows policymakers and business to understand how the economy is performed and make decisions based on information. It's also allowed the international comparison of economic performance.